Guarding your investments. The art of trailing stops and risk management. In the realm of investment, where uncertainty is the only constant, risk management emerges as a crucial discipline. Among the arsenal of risk mitigation strategies, the concept of a trailing stop stands out as a dynamic and proactive approach to safeguarding investment portfolios. Understanding the intricacies of trailing stops and their application in risk management requires a deep dive into the mechanics of this tool and its pivotal role in preserving capital while allowing for potential upside. The anatomy of a trailing stop. At its core, a trailing stop is a dynamic order that adjusts with the market price of an asset. Unlike a traditional stop-loss order, which remains static, a trailing stop trails the market, adjusting upward as the asset's price rises, and maintaining a set percentage or dollar amount below the peak value. This flexibility allows investors to capitalize on a security's upward momentum while establishing a predefined exit point to limit potential losses. To illustrate this concept, consider an investor who purchases shares of company A at $50 per share. Implementing a trailing stop at 10%, the investor sets a sell order at $45 per share. As the stock price climbs to $60, the trailing stop adjusts accordingly, now triggering a sell order at $54. This adaptive nature enables investors to lock in profits during upward movements while providing a safety net against downturns. Risk management in action. The primary application of trailing stops lies in their role as guardians of capital, executing a predefined exit strategy to mitigate losses. In a volatile market, where prices can fluctuate rapidly, having an automated mechanism to limit downside risk is invaluable. Trailing stops empower investors to establish a disciplined risk management framework, allowing for the preservation of gains and the protection of capital. Consider the scenario of a stock experiencing a robust uptrend. Without a trailing stop, investors might be hesitant to sell, hoping for further gains. However, markets are unpredictable, and trends can reverse unexpectedly. By employing a trailing stop, investors can ride the upward momentum while being shielded from abrupt downturns. This disciplined approach ensures that profits are captured and losses are minimized, aligning with the fundamental tenets of prudent risk management. Adaptability to market conditions. The beauty of trailing stops lies in their adaptability to various market conditions. In a trending market, where assets exhibit sustained upward or downward movements, trailing stops prove particularly effective. During bullish trends, the trailing stop rises with the asset's price, allowing investors to capture substantial gains while maintaining a safety net. Conversely, in bearish trends, trailing stops act as a disciplined exit strategy, preventing prolonged exposure to declining asset values. Consider an investor holding shares of a technology stock during a bullish market phase. The stock's price surges from $80 to $120. With a trailing stop set at 15%, the sell order triggers at $102. The investor not only captures a significant portion of the upward move but also protects against potential downturns. This adaptability is a hallmark of the trailing stop's utility, catering to diverse market scenarios. Embracing volatility with trailing stops. Volatility, often perceived as a double-edged sword, presents both opportunities and risks in the world of investing. Trailing stops offer a means to navigate this volatility with a calculated approach. As asset prices fluctuate, The trailing stop allows investors to participate in the potential gains while systematically mitigating the impact of downside risk. Consider a scenario where an investor holds shares of a biotech company awaiting the outcome of a critical clinical trial. The stock's price is susceptible to sharp movements based on trial results. Implementing a trailing stop in this situation enables the investor to benefit from positive outcomes while limiting losses in the event of unfavorable results. The trailing stop becomes a strategic ally in managing the inherent volatility associated with specific events or catalysts. The psychological edge of trailing stops. Beyond the quantitative benefits, trailing stops wield a psychological edge in the realm of investing. Emotions often run high in financial markets, with fear and greed driving decision-making. Trailing stops act as a rational and predetermined mechanism, removing the emotional burden associated with deciding when to sell. Investors can set their parameters, allowing the trailing stop to execute without succumbing to impulsive reactions in the face of market fluctuations. Consider the emotional toll of witnessing a favorite stock's value decline. Without a disciplined strategy, investors might cling to hope, hesitating to sell in anticipation of a rebound. Trailing stops provide a structured and unemotional approach, executing sell orders based on predetermined criteria. This psychological benefit frees investors from the mental anguish of decision-making during turbulent market conditions. The balance between risk and reward. While trailing stops offer robust risk management capabilities, it's essential to strike a balance between risk and reward. Aggressive trailing stop settings may lead to premature exits, limiting potential gains. Conversely, overly lenient settings could expose investors to significant losses during market downturns. Finding the optimal balance requires a thoughtful consideration of individual risk tolerance, investment goals, and market conditions. Consider an investor holding shares of a growth stock with a history of volatile price swings. A trailing stop set too conservatively might trigger sell orders during routine fluctuations, missing out on the stock's long-term appreciation. Conversely, an excessively liberal trailing stop might expose the investor to undue risk during market corrections. Striking the right balance involves aligning trailing stop parameters with the asset's historical volatility and the investor's risk appetite. Conclusion. In the ever-evolving landscape of investing, where uncertainty is the only certainty, the concept of trailing stops emerges as a powerful ally in the pursuit of risk management. As a dynamic and adaptive tool, trailing stops empower investors to navigate the complexities of financial markets with a structured approach to profit-taking and loss mitigation. By marrying disciplined strategy with the flexibility to capture potential gains, trailing stops stand as a testament to the art and science of prudent risk management. Investors who master the application of trailing stops wield a formidable weapon in their arsenal, ensuring a resilient and strategic approach to safeguarding their hard-earned capital in the dynamic world of finance.